Trump crashes markets with new tariffs. WTI oil breaks critical level despite military action. Kazakhstani tenge under pressure. Taliban changes regional power balance. Stay tuned. We're breaking down everything right now. Welcome to the Strifor channel. Today we're focusing on the fascinating world of geopolitics and how it's literally reshaping financial markets before our very eyes. And by the way, don't forget to subscribe to the channel and hit the like button. Why? Because every subscription helps us create even deeper analysis. At the center of current events are several key players who are literally pulling the strings of the global financial theater. And yes, this is not an exaggeration. Trump with his protectionist agenda is like a bull in a china shop of global trade. Every statement he makes about tariffs causes algorithms to shuffle billions between assets within seconds. But here's the paradox. Markets have already learned not to panic at his every tweet. And now, the most interesting part. Russia's energy agenda has turned into a real roller coaster for oil prices. Drone attacks on Russian energy infrastructure, you'd think prices should skyrocket, right? Wrong. WTI oil quotes not only failed to rise, but actually lost their so-called war premium, plummeting below the critical level of $65.42 per barrel. It's like a factory fire leading to lower prices for its products. Sounds illogical, but markets operate by their own laws. The secret is simple but treacherous. The OPEC Plus cartel decided to open the taps wider. In August-September, alliance members increased supply by a colossal 548,000 barrels per day. Imagine, it's as if an additional 548,000 barrels of oil were thrown onto the market every day. With weak global demand, this created pressure that swept away any war premium. But here's where it gets interesting. Geopolitics works both ways. Recent upward oil movements show that markets are still nervous. Besides attacks on Russian infrastructure, regional instability in Central Asia and Afghanistan is growing. Markets view the strengthening influence of the Taliban movement as an indirect risk factor for commodity flows. What's happening with Kazakhstan? A real currency drama is unfolding here. The national currency, the tenge, is experiencing pressure as if a steamroller ran over it. And this isn't just general commodity trends. It's a perfect storm of rising domestic inflation risks, plus regional turbulence from the Taliban's growing influence. Imagine yourself standing in the center of a storm, with inflation winds blowing from one side and a hurricane of geopolitical uncertainty from the other. That's what the Kazakhstani economy is experiencing right now, and now, the most paradoxical moment. Financial markets behave like experienced poker players, outwardly calm but internally calculating every move. We're observing moderate risk-off, a slight decline in risk appetite, but simultaneously, attention. Investors continue betting on U.S. monetary policy easing. It's like dancing on a knife's edge. The American economy is showing growth of around 2.5% with a strong labor market. But everyone's asking, isn't everything already too well priced in? And here, Jerome Powell enters the stage. His dovish speech worked like balm on investors' wounds, supporting expectations of imminent interest rate cuts. Analysts have already drawn up a scenario. Just 3 rate cuts in 2025 to a target range of 3.50 to 3.75%. Doesn't sound very impressive, but for markets, it's like a breath of fresh air. How does this reflect on currency markets? The EUR to USD pair maintains an upward trend from March lows, establishing itself above the 1.11 level and consolidating around 1.1719. This directly reflects declining interest in the dollar and expectations of softer Fed policy. Meanwhile, the USD-JPY pair fluctuates in a wide range of 141 to 149. The break of the ascending trend line and consolidation below the 148.01 level indicate weakening dollar momentum. The yen is once again acquiring safe haven status amid geopolitical uncertainty. By the way, if you want to trade these and other instruments, the Strifor platform provides access to more than 250 instruments, including currencies, indices, and derivatives. Create an account, try the demo version, and see what you're capable of. And if you want not just to trade, but also earn additional income, we have a partnership program with payouts up to 60% of the spread from referred clients. Demo account link in the video description. But here's where the real magic, or danger, begins. The VIX Fear Index remains in a sleepy range of 14 to 17 points. It's like a thermometer of market calm, and right now it's showing everything's fine. You can sleep peacefully. This is where the catch lies. With overvalued indices, this idol can explode faster than you can blink. Low VIX is like a calm sea before a tsunami. Investors are practically not hedging against risks, making the market incredibly fragile to any surprises. What does the current situation show? US stocks maintain bullish sentiment but become increasingly vulnerable to rising volatility. Oil is under pressure from excess supply but bounces on any geopolitical news. The euro strengthens against the dollar while the yen maintains its safe haven status. Uncertainty and volatility have become permanent elements of the geopolitical landscape, while American policy remains a key driving factor. First scenario: if U.S. macroeconomic data, labor market, consumer price index, consumer activity show resilience, the Fed may maintain a wait-and-see position. In this case, the dollar will retain support and stock indices will fluctuate within current levels. Second scenario: weaker data will strengthen expectations of imminent policy easing. This will put weakening pressure on the dollar and support the euro, gold, and oil. In such a situation, commodity currencies, including the Russian ruble, may receive support. Third scenario, the most dangerous: a sharp rise in the VIX index will signal a possible correction in overvalued indices. Even while generally maintaining soft Fed expectations, this could lead to significant losses in stock markets. The current geopolitical situation creates a unique combination of factors. On one hand, fundamental risks are growing, from trade wars to regional conflicts. On the other hand, central banks are ready to support markets through policy easing. For traders, this means the necessity of constant monitoring not only of economic data but also geopolitical news. Events in Afghanistan, Taliban actions, the situation with Russian energy, pressure on the tenge. All these are links in one chain affecting global financial flows. And to learn how to properly analyze these signals, check out our Strifor Telegram channel. We've prepared a gift there: 10 rules for millionaires from the legendary book Market Wizards. These principles will help you think like a professional trader. Get the PDF for free, link in the description. Key assets to watch: oil as a barometer of geopolitical tension, EUR-USD as an indicator of central bank policy expectations, and the VIX index as a measure of market complacency. Conclusion and call to action: geopolitics and markets are inextricably linked, and understanding these connections is key to successful trading. Subscribe to the Strifor channel to not miss important analytical materials, and like this video if the information was useful. In the comments, share your thoughts on which geopolitical events, in your opinion, will have the greatest impact on markets in the coming months. See you in upcoming episodes.